Welcome back to our channel. In today's video, we'll be talking about the recent decisions made in the latest FOMC meeting. As they have chosen to pause their aggressive campaign of interest rate hikes, various market sectors have been impacted. So let's explore what happened. The FOMC, led by Federal Reserve Chairman Jerome Powell, made the surprising choice to keep its benchmark lending rate unchanged for now. This means that they have decided not to raise interest rates, despite acknowledging the presence of elevated inflation. They expressed the need for additional time to gather information and assess its potential impact on monetary policy before making further decisions. As news of the Fed's decision spread, it triggered immediate reactions in the market. For example, let's take a closer look at how two of the main sectors responded. Gold prices experienced a surge initially, driven by the perception that the Fed's decision signaled a dovish stance on interest rates. However, the gains were later trimmed when the Fed hinted at the possibility of future rate hikes. Gold prices are typically sensitive to rising interest rates because they increase the opportunity cost of holding non-yielding assets like gold. On the other hand, oil prices took a downward turn after the Fed's announcement. This was primarily due to concerns about future demand, further amplified by the Fed's projection of additional interest rate hikes for the year. Additionally, an unexpected build in U.S. crude oil stocks added downward pressure to oil prices. So it was a combination of the Fed's rate outlook and concerns about oil demand that caused prices to drop. Despite the decision to pause rate hikes, it's important to note that the Fed still recognizes the presence of elevated inflation. Chairman Powell emphasized the likelihood of further rate increases this year to bring inflation down to its target of 2% over time. The Fed remains committed to addressing inflation, but wants to assess the impact of its previous rate hikes before proceeding with further adjustments. So, what are investors expecting in light of this decision? Many anticipate a resumption of rate increases in the near future. The Fed's projections and outlook have led investors to prepare for quarter percentage point rate hikes, possibly starting at the next policy meeting scheduled for July. This indicates that market participants are bracing themselves for tighter monetary policy in the coming months. Bond traders in particular have adjusted their positions accordingly. They are now less inclined to believe that the Fed will lower interest rates this year. Rates on swap contracts referencing future Fed policy meetings reflect a peak rate in September, signaling the expectation of a tightening monetary policy. Bond traders are aligning their strategies with the Fed's signal of more rate hikes in the future. To summarize, the Fed's decision to pause its aggressive interest rate hikes has had a notable impact on the market. Gold and oil prices reacted differently, with gold initially rising and oil declining. The market anticipates future rate hikes, while bond traders have adjusted their positions to align with the Fed's projected path. The pause in rate hikes does not indicate a shift in the Fed's approach to inflation, as they still acknowledge its presence and plan for further rate increases. As we move forward, it's important for investors to stay informed about the Fed's future decisions, as they may resume their campaign of rate hikes in response to evolving economic conditions. Keep an eye on inflation trends, economic data, and the Fed's communication to gauge the potential impact on various sectors of the market. Remember to consult with a professional financial advisor before making any investment decisions. Thank you for watching today's video. If you found it informative, please give it a thumbs up and subscribe to our channel for more insightful content.